I've been asked by my followers and subscribers to give some guidance on how macroeconomics or fundamentals affect financial markets. I want to start just by saying, though, the reason I use technical analysis in order to identify low-risk trade opportunities is because it gives you a much clearer idea of how to time a trade, where to put your stop loss, where to put your target, or how to calculate your risk versus reward. I find that trading fundamentally doesn't do that. You don't know when markets are going to decide to react to the fundamentals that have been developing over a period of time. And of course, fundamentals change very quickly. Technical analysis will allow you to spot that more quickly. That's in my opinion. Technical analysts also believe that once a piece of fundamental news has been released into the market, all market participants who need to react to that, those who have positions on or those who are intending to put positions on, will react to the news eventually over a short period of time, and therefore that news is automatically absorbed and the prices have already reacted. So in effect, technical analysts are saying we don't need to know every piece of information. We don't need to know every piece of economic data. We just know that the data will be absorbed into the price. And of course it is, because we read news headlines every day. Oh, the stock market went up because CPI came in weaker than expected and the stock markets are hoping for a rate cut, something like that. I mean, I think those headlines are a bit dodgy, because did the whole market, all the millions of participants who are investors or traders in the stock market, all decide to buy for that one reason? We all have different reasons why we execute orders. It might simply be, I'm going for lunch and I don't want a position open, so I'm going to close it. Or it might be, it's Friday afternoon, I'm going to go home early. You know, there's all sorts of different reasons why people open and close positions. So when you see these headlines, I do have a little chuckle to myself. How did they know that all the millions of traders and investors in the world all decided to buy the stock market for this one reason? However, having said that, it is always good to understand as much information about the financial markets as you can if you're going to be involved in trading them. And there's certainly no harm in understanding the fundamentals and the background and what's going on in the economy and the geopolitical stage. I certainly do keep that in mind. I'm interested to know what's going on in the world in financial markets and have that in the back of my mind. I've had over 35 years experience of watching news being released. And I did do an A-level back in the 80s in economics, so I had a basic understanding when I started working in the city anyway. Another point to note is that there's a trend in what's popular or what the market is focused on. So, for example, back in the late 80s, early 90s, unemployment was a real big number. It still is, but even bigger than that was the trade deficit. Those days, that was the equivalent of CPI now. CPI now, the Consumer Price Index, or the measure of inflation, is probably the most important number of the month. Preceding that, it was the unemployment number, non-farm payroll. But as I say, back in the late 80s, early 90s, it was the trade balance, which was the real big market moving number. Right now, as I speak to you in May 2024, it's definitely all about inflation, because of course inflation got out of control. The Fed is still trying to get inflation fully under control. And so every piece of data is analyzed as to whether it indicates there will be a cut in interest rates because inflation is continuing to ease, or will interest rates be held because inflation is not easing as much as expected, or could interest rates even go up because CPI, certainly in the beginning of 2024, appeared to be creeping back up. Okay, part one, let's try to get an understanding of macroeconomics, the definition and scope of macroeconomics in the context of global financial markets. So macroeconomics is a brand of economics that studies the behavior, the performance, the structure, and decision-making of an economy as a whole. This includes national, regional, and global economies. In the context of global financial markets, macroeconomies play a crucial role by examining how the aggregate indicators such as GDP, gross domestic product, inflation rates, CPI, PPI, unemployment, and monetary and fiscal policies influence market trends and trading decisions. Macroeconomics provides traders and investors with a broad perspective on the economic conditions affecting financial markets. It helps in understanding the dynamics of supply and demand, interest rates, and exchange rates, all of which are pivotal in making informed trading decisions in Forex, futures, and commodity markets. So the distinction between macroeconomics and microeconomics: macroeconomics looks at the economy from a broad lens. Microeconomics focuses on individual sectors. firms and consumers within the economy. The main difference lies in the scale of the analysis. So, for example, when a trader analyzes the impact of a change in the US Federal Reserve's interest rate policy, they might consider a macroeconomic factor. In contrast, when examining the financial health of a specific company to buy its stock involves microeconomic analysis. So for the kind of trading that myself and my subscribers are doing, looking at Forex, gold, stock markets, commodities, we might look at the overall economic growth rate of a country to decide on whether we're investing in its currency. So for example, if it looks like interest rates might go up because the US economy is doing well, we might decide to be trading the dollar from the long side, looking for buying opportunities. A strong GDP growth rate might indicate a bullish market for the country's currency, whereas conversely, a trader deciding on buying shares in a tech company would look at the company's earnings reports, product launches, marketing and market competition, focusing on microeconomic factors. Quick bit of history. Macroeconomic theory has evolved significantly over the years, influencing trading strategies and financial market dynamics. The Great Depression of the 1930s led to the development of Keynesian economics, which emphasized the role of government spending and fiscal policy in managing economic cycles. This theory laid the groundwork for understanding how government actions can influence economic growth and consequently financial markets. In the 1970s, the stagflation scenario, which was a state of high inflation coupled with high unemployment, a nightmare scenario, challenged Keynesian principles, leading to the rise of monetarist and supply-side economic theories. These theories highlighted the importance of monetary policy and market-driven supply and demand as economic drivers, influencing central banks' approach to managing inflation and interest rates, which are critical factors for traders in financial markets and could not be more critical at this time. The evolution of macroeconomic theory has equipped traders with a deeper understanding of how economic policies and global economic events influence financial markets. This historical perspective enables traders to anticipate market movements based on macroeconomic indicators and government policy changes, making it an indispensable tool in their trading arsenal. Traders will focus very closely to monitor the release of economic indicators to forecast market trends. Even if you're a technical analyst like me, you're always going to be aware of what numbers are being released during the week, even if it is only to make sure that you don't have a high risk position on over the release of that data, because obviously you can get a very unexpected volatile move. So before the release of an economic report, traders analyze historical data and market conditions to predict the report's outcome and its potential market impact. Now, you may not do that, and I don't do that, but when you look at financial news, you'll see that analysts have a prediction and they base that on looking at historical data and market conditions. So upon the release, markets react extremely quickly, almost instantaneously to the data. As we know, better than expected report can boost market sentiment. Now, better than expected is a relative term because CPI could be better than expected. In other words, it could be higher than expected, but that might not mean it's a good number for the economy, and it could cause worries about higher interest rates, which would push the stock market down while pushing the dollar up. Now, fundamental traders might adjust their strategies based on the new data, taking positions that align with the anticipated market direction. And of course, we see that all the time after economic data has been released, which is out of line. I mean, at the moment, if CPI is out of line by 0.1% from expectations, it can create quite a dramatic move in stock markets, Forex markets, gold. The disparity between the expected and the actual figures can lead to increased volatility the further away the release is from the expectations, which would be from a pool of investment banks such as JP Morgan, Goldman Sachs. We would all have their expectations for the release, and it will be an average of all those expectations. Markets tend to price in expectations ahead of the release, so a significant deviation can cause rapid repositioning, leading to big price swings. I'm sure you've seen that many, many times. Concerning long-term trends, beyond the immediate reaction, economic indicators can set the tone for long-term market trends. For example, a series of reports indicating rising inflation, as we had at the beginning of 2024, may lead to expectations of monetary tightening, or certainly not the expected monetary loosening that we had thought was going to happen at the beginning of the year. So this will affect various asset classes over time. Now, if you are a fundamental trader, then understanding the role of economic indicators in trading is foundational for day traders looking to navigate the complexities of financial markets. By interpreting these indicators accurately, traders can gain an edge in forecasting market trends and manage risk effectively. Now, for those of you who are perhaps more beginners than others, I'm just going to quickly run through the differences between the Forex markets, futures markets, and commodities. So the Forex market, also known as the foreign exchange market, is the largest and most liquid financial market globally. It involves the trading of currencies and operates 24 hours a day, 5 days a week. Traders engage in buying and selling currency pairs, such as the euro versus the US dollar or the British pound versus the Japanese yen, to profit from fluctuations in exchange rates. Macroeconomic indicators, such as interest rates, inflation, and economic growth, play a pivotal role in influencing currency values. In fact, I would say that the Forex market is probably the market that would react the most to macroeconomic data. For instance, a country experiencing higher economic growth rates compared to another can see its currency appreciate in value pretty much for the sole reason that you would expect higher interest rates in the country that is growing at a more rapid pace, because they are more likely to trigger inflation in that economy, which would be met with eventually higher interest rates by the central bank to control inflation. Now, for those of you who are not familiar with the futures market, which is actually where I started my career I was working on the London International Financial Futures Exchange as an options market maker. This involves contracts to buy or sell a particular commodity or financial instrument at a predetermined future date and price. It covers a wide range of assets, including agricultural products, energy, metals, and financial instruments like indices and currencies. The difference between futures and Forex is that futures are traded on a centralized exchange. The first one to evolve was in Chicago. Forex markets or currency values are highly sensitive to interest rate changes, which I've touched on already. Positive economic news from a country can strengthen its currency, as it may lead to higher inflation, which in turn would lead to higher interest rates. And that attracts more foreign capital. If it looks like interest rates might be going up in the US, money might flood into the US in order to take advantage of a higher interest rate in bonds or maybe in bank accounts. In the commodities futures markets, economic reports that suggest a future shortage or surplus in commodities can lead to significant price movements. For example, an unexpected decrease in oil supply due to geopolitical tensions can cause oil prices to spike up. Okay, let's look at some of the more important economic data. Gross domestic product, GDP, is a paramount economic indicator because it encapsulates the total monetary value of all goods and all services produced over a specific period of time within the country's borders. So it serves as a comprehensive measure of a nation's economic health. In fact, the whole of the nation's economic output and its trajectory of growth or contraction. GDP is calculated using several components, each offering insights into different sectors of the economy. These include consumption, the total value of all goods and services consumed by households, by the general public. It is the largest component of GDP and reflects consumer spending habits. Investment, this includes business investments in equipment, residential construction, and changes in business inventories. It indicates business confidence and future economic activity. Government spending, that's a big one in the US with their trillions of dollars in debt. So total government expenditure on goods and services. High government spending can stimulate economic growth, certainly has been doing that in the US, whereas cuts in spending can have the opposite effect. A stronger than expected GDP number indicates that an economy is performing better than it was expected to be doing. If the economy is growing at a very rapid pace, it can cause worries about overheating in the economy, which would lead to inflation, which will lead to higher interest rates. And depending on the mood of the stock markets, an increase in GDP can be seen as positive because it means consumers are spending more money. Companies may be able to increase their margins. They certainly might be able to sell more goods and services. If everyone is employed, earning money, spending money, leading to higher GDP, it's obviously good for companies. The problem comes when the worries about overheating and the stock market start to worry about higher interest rates. That would cause higher cost of borrowing or cost in loans that they may already have. And it also might cause companies to cut back on future plans to borrow money because the interest rates might be too high. So perversely, a significantly increasing GDP number can eventually cause the stock markets to fall. The consumer price index and the producer price index are really important numbers. Understanding these indicators, therefore, is crucial for traders in the Forex and commodity markets, as they provide valuable insights into inflationary trends, influencing market expectations and central bank policies. So the consumer price index, I, measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. It is a critical indicator of consumer inflation and is often used to adjust salaries, pensions, and tax brackets for inflation. CPI is calculated by collecting prices of a sample of items, which are weighted according to their importance in the average expenditures of household. The index compares the current price level to a base year, providing a percentage that indicates the inflation rate. So for traders like us, the CPI is a direct indicator of purchasing power and consumer demand. A rising CPI suggests inflation is increasing, which can lead to higher interest rates as central banks aim to control inflation. It can strengthen its currency as it attracts foreign capital seeking higher returns. Now, the producer price index measures the average change over time in the selling prices received by domestic producers for their output. So, unlike CPI, which measures prices from the consumer's perspective, the PPI, producer price index, reflects prices from the producer's perspective. PPI is calculated by tracking the selling prices of goods and services, factoring changes in production costs. PPI can therefore be an early indicator of inflation because it measures price changes before they reach the consumer. A significant rise in PPI suggests that costs to the producer may eventually be passed on to consumers. Producers tend to try to absorb these price rises initially themselves in the hope that it's temporary, but if the price rises are sticking, then they will eventually have to pass these rises on to consumers, otherwise their margins will be cut. Employment or unemployment is obviously an important economic indicator, focusing on the unemployment rate and non-farm payroll data that we see on the first Friday of every month from the US. And it can have a profound effect on financial markets. I'm sure if you've been trading, you might have been caught on the wrong side of these numbers. I certainly have been. Understanding these indicators is paramount for traders aiming to forecast market trends and making informed decisions. Employment indicators are among the most closely watched economic data by traders and investors alike. It's only recently, in fact, the CPI has become more important than unemployment. The unemployment rate is obviously the percentage of the total workforce that is unemployed and actively seeking employment. A rising unemployment rate is a sign of economic slowdown, of course. If people are losing their jobs, they're going to be spending less. And if people who are employed are seeing unemployment rise, they might be worried about losing their jobs in the future and will also cut back on spending. The non-farm payroll number represents the total number of paid workers of any business, including farm employees, government employees, and employees of non-profit organizations. The non-farm payroll, NFP report, is a leading indicator of consumer spending, of course, because it measures the power of people to spend, which accounts for the majority of overall economic activity. So unemployment and the non-farm payroll number can have a less direct effect on inflation, but still, if you see a higher than expected unemployment rate, more people are losing their jobs than expected, it's going to create uncertainty and nervousness and could cause a cutback in consumer spending, which would be deflationary. It could stop inflation rising, and in the worst case scenario, if economy is already quite weak, it could cause deflation where prices are actually going down. Of course, if more people are getting jobs, more people are earning, have more power in demanding pay rises, the more people earn, the more people spend, which creates more demand and therefore can feed through to overheating in the economy. So, for example, if it's 1:30 p.m. in the UK on the first Friday of the month and you're waiting for the non-farm payroll unemployment number and you think that there will be more jobs created, in other words, the unemployment number will be lower than expected, you might want to buy the dollar. If you thought unemployment might be higher than expected, you might want to sell the dollar. Now, retail sales data is a pivotal economic indicator that provides insights into consumer spending habits and, by extension, the overall health of an economy. Of course, if people are doing well and have jobs, they're going to spend more, which means retail sales will be strong. And of course, the higher the demand, the more risk there is for higher inflation. Retail sales represents the total receipts from stores selling merchandise to the public, ranging from essential goods to luxury items. So this data is crucial for traders and investors as it reflects consumer confidence and purchasing power, which are key drivers, obviously, of economic activity. Consumer spending accounts for a significant portion of gross domestic product, GDP, in many economies, making retail sales a valuable metric for assessing economic vitality. An increase in retail sales suggests that consumers are confident in their financial situation and the economy, indicating economic expansion. Conversely, A decline in retail sales means people are spending less and can obviously signal economic contraction as reduced consumer spending affects business revenues, leading to cutbacks and layoffs. So what you can see is all of these numbers boil down to one thing. Are they expansionary for the economy? Do they indicate that the economy is growing? So if there are strong retail sales, if there's a strong unemployment number, strong GDP, strong CPI and PPI number, it's indicative of a growing economy, a strong economy, one where consumers might increase spending. They might even decide to borrow money because they're feeling confident about their jobs in the long term. And all of this means the risk of higher inflation, which means there is a risk of the central bank raising interest rates. For example, right now, as I speak to you, we're looking at potential cuts in Europe, or the ECB has indicated that they might be willing to cut interest rates sooner rather than later. Whereas in the US, we're not sure about that right now. Interest rates might be on hold for a longer period of time than we expected at the beginning of the year. So with that in mind, a trader might be thinking, I'd like to be short the euro versus the US dollar, because if interest rates start to come down in Europe, but they're held higher in the US, it would mean that the dollar would remain stronger because there might be a flow of money out of Europe and into America to take advantage of those higher interest rates. So investors might be inclined to sell the euro and buy the dollar as they move money cross borders to take advantage of a higher interest rate in the US. So the key point here is that central banks such as the Federal Reserve in the US and the European Central Bank, the ECB, and the Bank of England, and all the central banks around the world, they all use monetary policy as their main tool, pretty much their only tool, to influence the economy by controlling interest rates and the money supply. Their decisions on interest rates are closely watched by traders for that reason. If you want to understand how economic data is going to affect the dollar, commodities, stock markets, you have to understand what will be the effect on inflation. And if inflation starts to get out of control, will the central bank start to raise interest rates to control it? Or vice versa, as we have a situation now whereby inflation is becoming slowly under control, not as fast as central banks want it to be, but we are starting to talk about interest rate cuts around the world because inflation has been pulling back from those extreme peaks that we had in 2023, which will allow central banks to loosen monetary policy. And if going forward, we continue to see lower retail sales, higher unemployment, lower earnings, wages, average earnings, lower spending, lower retail sales, lower PPI, then that can lead to the expectation that inflation is coming down and the expectation that the central banks will be able to cut interest rates to try to re-stimulate the economy, and they have room to do that if inflation is declining. I hope that's been helpful. I really do value your comments and feedback, and do contact me if you've got questions.